With all the continuous advancements in the crypto space, it may be hard to keep up with. From cryptocurrency to meme coin to NFTs, it boggles one's mind. But that's what we are here for, to break it down. If you have been watching the space, one type of coin that has been on the rise lately is that of stablecoins. So today we will be looking at what they are and their impact on fintech. Let's start with what are stablecoins. To put it simply, a stablecoin is a digital currency that is pegged to a stable reserve asset such as gold or the US dollar. Pegging in the traditional sense is a way of controlling a country's currency rate by tying it to another country's currency or assets, and therefore is used the same way with the stablecoin. These coins can be pegged to fiat currencies such as United States dollar, other cryptocurrencies, precious metals, or a combination of the three. Fiat currencies seem to be the most popular option in the marketplace right now, meaning 1 unit of stablecoin equals $1. Stablecoins are designed to tackle the volatility seen in the cryptocurrency prices, especially over the last few years. They are normally collateralized, meaning that the total number of stablecoins in circulation is backed by assets held in reserve. Put simply, if there are 500,000 USD pegged coins in circulation, there should be at least $500,000 sitting in a bank. With Bitcoin suffering abrupt crashes and sudden gains, it's believed stablecoins will help eliminate doubt about conversion rates, making cryptocurrencies more practical for buying goods and services. So you may be wondering, how do they work? As the name suggests, stablecoins are designed to have a consistent price or value over time. There are 3 different ways of achieving this. The first type of stablecoin is collateralized by fiat currency. For every single stablecoin issued, $1 is kept safely by a central custodian, such as a bank. This means that, in theory, you should be able to exchange between the two extremely simply, without great expense. Next, you have stablecoins collateralized by cryptocurrency. I know you are thinking, doesn't this defeat the whole purpose, as it means that price volatility is possible? To an extent, yes. But some providers try to tackle this issue by over-collateralization, meaning $2 worth of crypto is deposited with a custodian for every $1 of stablecoin. This can help to keep decentralization alive, with crypto reserves absorbing the impact of any fluctuations. But a downside is that a huge amount of capital can be required to get them off the ground. Lastly, there are non-collateralized stablecoins, which do away with the idea of having reserves altogether. These types of assets see smart contracts take on a role not too dissimilar to a reserve bank. They monitor supply and demand, buying circulating coins when prices are too low and issuing new ones when prices are becoming too high. The ultimate goal is to keep prices in line with that of a pegged asset such as the US dollar. Stablecoins are useful and becoming more popular because they eliminate uncertainty for customers, especially around conversions. They offer the type of predictability that many countries struggle to achieve with their national currencies. Stablecoins give owners a safe place to store their assets whenever there are major volatilities in the crypto world. Consumers can quickly and easily convert from unpegged cryptocurrencies to stablecoins when they are worried about where the markets are heading next, eliminating the need to return to a fiat currency. These conversions can also be less expensive than switching between crypto and fiat, as it takes the transaction fees of payment processing providers and banks out of the equation. With this information, the question remains, can stablecoins achieve true decentralization? Some stablecoin advocates are concerned that pegging a cryptocurrency directly to the US dollar means that it must inevitably have ties to the US banking system. This means that they have to rely on a centralized infrastructure, something that has enticed so many to invest in the crypto realm as it is decentralized. Now the question remains, how do stablecoins affect fintech? As we know, traditional banks are slow but surely jumping on the blockchain and crypto train, but still remain very skeptical as they are concerned about the decentralization and regulations, and therefore keeping growth quite low in the sector in regards to what it could be. Understandably, the volatility of the market doesn't help instill confidence in them. Therefore, having a coin that is pegged to an asset will offer traditional banks a bit of security as the volatility is lowered. And stablecoins inhabit the same realm as Bitcoin and other cryptocurrencies, in that they are electronic, can be exchanged peer-to-peer, and are not issued by central banks. Stablecoins are token-based. Their validity is verified based on the token itself, rather than the identity of the counterpart, as is the case for account-based payments, and therefore allows them to enter the digital space. It in turn allows fintech companies to get a foothold into establishments that opposed or resisted evolving, and then from there can expand their offerings. With new stablecoins launching all the time and trading volumes on the rise, this is a segment of the crypto industry that could grow further in the coming years. Undoubtedly, new use cases will emerge along the way, potentially offering a temptation to consumers who have been reluctant to use virtual currencies so far. Examples of the best known stablecoins include Tether, TrueUSD, Gemini Dollar, and the USD coin by Circle and Coinbase. Demand for such coins has been growing. What are your thoughts about stablecoins? Do you think they can achieve true decentralization? Let us know in the comments below. We would love to hear your thoughts. Thank you for watching, and if you enjoyed the video, please make sure to hit that like and subscribe button so not to miss out on more.